Ladies and gentlemen, usually when I join you during Intel's earnings report, it's a very somber affair. Usually the company has missed expectations. They've lowered guidance. They've announced that they're likely cutting tens of thousands of staff in the great San Jose, California area. Usually shares have gapped down and headed lower, and the fanboys still try to get in the comment sections and try to defend a once giant company that has completely fallen from grace. Today, it's a new day, folks. We are going to be talking about Intel Corporation when they reported their Q3 earnings, and shares, at least at the current time, are up over 9.34%. Is this a turning point for Intel? Can we say the trouble and the worst is over? Is the bottom in for Intel stock? Should you have bought this stock a month ago, a week ago, 2 weeks ago? Is this one of the great American turnaround stories? Or is this simply a dead cat bouncing off of the pavement that is going to wither away in the sunshine as the rest of the semiconductor industry continues to pass it by? We'll talk about all those things on today's show. What is going on, investors? Hopefully, guys are doing well out there. You're not doing well if you've been holding Intel stock. Year to date, you're down 57%. Over the past year, you are down 41%. Over the past 6 months, you're down 30%. Even over the past month, you were down 8% on Intel. So don't get too excited. And we'll talk about method investing here in a moment, but we've got to get into these Q3 results for Intel. Revenue came in at $13.3 billion. That was a decline. Yes, a decline. Understand that the semiconductor industry is a cyclical business, meaning it goes up and down, up and down. We are in an up cycle like we've never seen before in the semiconductor business, and Intel's business declined. This comes in a quarter when they slashed. Slash might be a generous term for the margins over at Intel. I mean, they basically dropped these as low as they possibly can go. That explains a lot of AMD's results. Talk about that more here in a second. But they did beat expectations by $240 million. Understand, though, those expectations have completely fallen on the floor. At one time, analysts were expecting Q3 revenue for Intel up over $22 billion. $22 billion, and they just put up $13 billion. So one thing I think that is absolutely certain with Intel is that Wall Street has reset this company from an expectations perspective. And so going forward, we start looking out to next quarter, the next couple of quarters. $14 billion doesn't seem like a high bar. Now, it's a far cry from what the expectations were maybe a year and a half, 2 years ago, but we have a resetting over at Intel. Now, we also got Q3 guidance as well. We'll get into the numbers here in a moment. You're going to want to stick around and look for these. Even though the stock is up 9%, I'm going to show you some things that are still really alarming with this company. Now, they gave us a Q4 guidance. Look, this is really good guidance. Keeping in mind that it's from like a lowered expectation standpoint. Revenue, $13.3 billion up to $14.3 billion. The expectations was for $13.7 billion. Again, the lowered expectations. High-end estimate was closer to about 15. So finally, we have a quarter where Intel does what basically everybody in the semiconductor business is doing. They're beating, at least on the revenue side, and they're raising. So this company has finally found its sweet spot with setting expectations, and certainly the bleeding from the investment standpoint, at least the revenue side, not from the profit side. That got even uglier this quarter. Now, one thing that I do want to point out, this relates to AMD, maybe some other semiconductor companies, but particularly AMD. When AMD reported their earnings earlier this week, the guidance was a little tepid. Like, the guidance wasn't really over and above what the expectations were. In fact, it was down below the expectations set by most of Wall Street. And I think we just found our reason why. Look at the gross margins over at Intel. They went from 42.5% last year down to 15%. Oh my gosh, this is almost unheard of in this business. Typically, you're running at like a 40-50. If you're NVIDIA, you're running at 70% gross margins. So this company is giving away its product. And when you're sitting there, you're AMD, you sell basically the exact same product, at least from a processor, x86 processor standpoint. It's tough for AMD to compete against this because Intel is coming to the boardroom and basically saying, well, we're going to slash our pricing. AMD is trying to sit there and maintain some margin. So it's going to be a difficult business between these two companies going forward. But one way you could view this is desperation by Intel. This is absolute desperation that they had to slash the margins in order to maintain some type of revenue. Because look at the result when you slash the margins like this. $13.3 billion worth of revenue. Again, that was a decline year over year by about 6%. Now, our cost of sales coming in at $11.3 billion. Again, higher than it was last year. Look at your gross margin. Off of this $13.3 billion in revenue, we churned out just $2 billion. The problem with that is you're not going to be able to cut your cost fast enough over at Intel. Your R&D cost coming in at $4 billion in a quarter. Yeah, so you guessed it. Before we pay any other expenses over at Intel, the $4 billion in R&D is already double our gross profit. So this is what happens when you slash the margins. Yes, you are going to be able to put up a subsequent quarter, the upcoming quarter, where you're going to be able to come over and above expectations. Because if you're sitting there in the boardroom and you're Meta or you're Amazon or one of these other cloud providers that use Intel or AMD, and Intel's coming in there and basically giving you their product at cost or just 15% above cost, and AMD's trying to get 40% margin above cost, well, obviously, you're probably going to go with Intel. And that is exactly what customers have decided to do. So it's a Band-Aid on a bigger problem for Intel because they still have marketing, general, administrative costs. That came in at $1.3 billion. That's still almost in excess of their gross margin. Now you have these restructuring charges, which the company has announced over the past month or two, where they're going to be laying off quite a bit of workers. I think they're looking for an annualized saving of $10 billion. You have to recognize this restructuring cost right here inside of your operating profits as it is coming off the books. We'll add it back in cash flows when we get there in a moment. But you can strip this out if you want to. If you want to analyze Intel like a year from now where they're not going to be laying off any more workers, go right ahead. Our operating expenses instead of $11 billion would be closer to maybe $5.5 billion. But look at your operating loss over this company. It's still $9 billion. And really all you need to focus on is the fact that our gross margin off of this 13.3 in revenue. And again, the upcoming quarter will likely be in that 13.3, $14.3 billion mark. If Intel operates at the same margins, which we have to assume they probably will, where they're going to burn through and bleed through even more money next quarter. They burned through about $9 billion operating the company, flow down to net income, and you lost an unbelievable $17 billion. Imagine if you get a president elected next week that slaps tariffs on notebook computers, which I saw a report could raise the price of a notebook computer by 20 to 30% here in this country. And that's probably what's likely to happen. And so what is Intel going to do if all of a sudden there's a tariff on their goods coming back into the United States? We'll see what happens. Again, they're going to be able to manufacture some of these computer chips here in the United States, but they're not making the laptop here. That computer chip gets made here in America and it actually gets shipped back to China to get put in a cell phone or a computer. So there's still going to be, even when you make the chips here in the United States, if you're not making the device, the end device that it goes into, you still have to wonder about that. Now, I'm not arguing if tariffs are good or bad. I think there's pluses and minuses to all types of economic policy. But this is something that the company will probably have to address, and most companies will have to address over the coming weeks ahead. From a balance sheet perspective, it's not at all good. We still have $23 billion in cash, but we've got a mountain of debt, over $46 billion on the long-term side. And on the short-term side, we're well north of $3.7 billion. Here's where the rubber meets the road for the company is a 9-month cash flow statement. Pulled out a net income of $19 billion. We get to add back in depreciation, stock-based compensation. Imagine having stock-based compensation of $2.9 billion or $2.8 billion over the past 9 months. And you have restructuring charges here as well. Total adjustments give you about $5.1 billion of operating cash flow. So despite all these pretty hefty adjustments, the company still saw its operating cash flow go from $6.9 billion down to $5.1. We do have to factor in that the valuation in this company has basically gotten slammed to the floor at about $100 billion. So these numbers are really, really dismal. But again, the performance of the stock has brought it in at least in line with expectations. Now, the company, for some reason, continues to think it's going to manufacture these chips here in the United States. My guess is they probably will. I'll show you that they're not making any money doing that. But they spent over the last 9 months, they've spent about $18 billion on the addition of property, plant, and equipment. I wanted to see the run rate on this, since this basically just gives you a 9-month window into what they've spent. And last quarter, through 6 months, they had spent $11.6 billion. So they added nearly $8 billion. Excuse me, we're closer to $7 billion to the addition of property, plant, and equipment. That's more or less the run rate that they've been on over the past 3 quarters. They continue to issue debt because they're running at an operating loss and a cash flow loss over at this company. And when you slam your margins down to 15%, it's not going to get any better anytime soon. Now, it has boosted up the desktop and notebook PC sales, but again, year over year, you're actually declining there from 7.8 down to 7.3, but that is the cash cow operating side of the business, is this client computing group off of $7.3 billion worth of revenue. You had about $2.7 billion in operating profit. That's still a strong business, and obviously one with slimmer margins is still doing quite well. Now, data center and AI went from $3 billion up to about $3.3 billion. You squeezed out a respectable $347 million worth of profit there. We have network and edge came in at about $1.5 billion. That's about a $268 million of operating profit. So off of that business line, you churned out a decent $3.3 billion. The problem is the company still thinks they're going to be manufacturing chips. Here's your Intel Foundry. Those revenues actually declined year over year from 4.7 down to 4.4. And your operating losses rapidly expanded over here from $1.4 billion negative all the way up to $5.9 billion negative. And Altera, which is a company that they have on the block and they're trying to sell, saw its revenues decline $735 million down to $412, and they squeezed out just a measly $9 million in profit. So that's basically a break-even business on rapidly declining revenues. I don't know, a lot of people and a lot of investors are going to want to step in and buy that business unless they see a lot of synergies and they think it can turn it around. Folks, this is the investor channel, and you need a method of investing. And your method of investing, think about Warren Buffett. How many investments has Warren Buffett missed out on? Good investments has Warren Buffett missed out on over his entire life because his method of investing doesn't allow him to invest in a wide range of companies. He's probably never going to buy a company like NVIDIA. He's not going to buy some of the like Chipotle or some of these stocks or Monster Beverage, some of these stocks that have outperformed everything. But still, Warren Buffett's strategy delivers time and time again. Remember, when you're developing an investing strategy, it's not to have 100% success rate. You're not actually trying to be successful every time you look at a stock, that you pick the right direction that it's going in. What you want to try to do is just create a consistent method that is repeatable. And my method of investing doesn't involve investing in companies that have gross margins which have fallen from 42 to 15%. In fact, normally, if I wasn't recording this video, I would literally click the close button and go find another company to invest in. The second red flag for this company is they continue to lose money on an operating basis and a cash flow basis, and that is a major red flag in a cyclical business, which is in a cyclical upswing. Now, from a technical perspective, things are a little bit different for Intel. We have found some support. I'll switch this to a weekly view so we get a little bit of a view here. I have had this green box down here. Anywhere below $20 per share could be an area technically where you could buy something like this, but fundamentally, this one is an absolute disaster. I think the company is putting a Band-Aid over a much larger issue by slamming their gross margins to the ground. That is addressing the short-term problem with shoring up some of the revenue bleed that this company has experienced really over the past several years. But when the company is forced to raise those margins or expand them, will the customers continue to be there from an incremental basis, or will revenue continue to either stagnate or start to decline again? I think the latter is more likely than the former. Remember, when you're an investor, you're not going to get the direction of every stock right, but you want to have a repeatable formula. Buying stocks like this is not repeatable. And in a semiconductor industry where you have stocks like AMD, which over the past year are up 46%, and when you have stocks like NVIDIA, which are up 225%, I would simply continue to avoid the losers that are still trying to figure out a business model that is going to bring them into the new age. Folks, that was Intel's Q3. Finally, a little bright spot for the company, but I think more pain is coming. Good luck with your investments.